tax cuts generally are good for the economy. There's no doubt, right? So, for example, tax cuts would mean more money in the pockets of consumers. They can spend more, they can save more, they can invest more. Tax cuts for corporate sector mean better corporate profits, better corporate cash flows. That can mean more investment back into the economy, more people are hired, a stronger labor market. All of that leads to higher productivity, again, which is good for the economy. So nobody doubts that, I think. Now, the challenge comes with, it's not a free thing, right? You have a tax cut, you have to finance it, and the tax cut extensions would add about, roughly, give or take, $3 trillion on top of the deficit that we are running already. Our deficits are at 5%, 6% level right now, which is the largest level of fiscal deficit that the US government is running outside of a war situation and in a good economy. So if the economy falters, then the deficits, naturally, you can expect that to go up. So this is a lot, because what could happen is, and the bond market is already trying to kind of sniff this scenario out, if there's a prospect of bigger deficits, bond yields go up because investors want more compensation for holding bonds because they could be inflated away with bigger deficits. And bond yields are rising. So at some point that becomes a negative for the economy because it slows down borrowing, it slows down lending, it slows down spending, generally speaking. So you can give a tax cut out there, which is good, but then you can negate that with a higher level of bond yields, which is one of the reasons the primary reason we are calling our outlook report, which many would have seen, I hope, finding balance, fiscal adventures versus the bond market. This administration wants to get a lot done, but the ability to get that done will depend on how much the bond market allows the administration to get done.